All right, ladies and gentlemen, I hope you're having a wonderful weekend. I want to talk about something required to be, well, probably the only thing required to be a successful day trader, stock trader, and investing. I had to think there. And overall, just to accomplish anything financially speaking, but it has a really big thing focusing on day trading. So I'm going to go over a specific strategy, but before I do that, I want to, that's why I'm tuning in like this. We're going to cut to the screen. I figured we kind of mix it up, shout out all the OGs. You guys remember we do the weekend philosophy videos and all that. So I figured I'd use this opportunity to give you guys a positive message that pertains to what we're going to talk about, then cover the strategy and show you the stuff and, getting ready for this week and what we got going on with earnings and all of these opportunities, even what's going on globally. So yeah, let's get into it. Oh, make sure you guys subscribe, like the video. We're live Monday through Friday, 30 minutes for open. First link in the description, and we post videos here. And let me know if you guys want me to cover something even tomorrow. We're gonna get the watch list there. But here's your weekend philosophy, and I think it's we've had a lot of great 11 out of 11 calls, and this concept has came up, and I think we need to I'll leave you with this message. This is really a requirement to being successful in many ways, is focus on yourself, but in the sense of go with what's right for you. You don't ever try to force it. You could look at other people and see a lot of other people doing certain things. When it comes to finance, that's often what gets people into trouble. You guys have heard me say that with what Warren Buffett said, Benjamin Graham, all of those guys, and they talk about getting to the finish line as opposed to getting to the finish line first. And that's something I think we really all need to understand, and everybody's gonna have their own finish line. And if you don't, fuck social media, everything else you're seeing, some people are gonna do this. I may drive this car, some people may drive that, some people may make 10,000 here, some people may lose 10,000. The relativity makes sure that's what puts everything into context. Nothing means anything unless you know what you're comparing it to. What's a king to a guy, what's a guy to a king? But in all seriousness, so the best thing you can do, and if you feel like you're ever doing that, is just focus on what you have and what you got going on with you and the positive things, and understand somebody would kill for what you have, and at one point you were praying for what you got now. And in general, though, if you're able to appreciate what you have now, this comes down to stocks. This comes down to trading. If you were able to appreciate what your dollar means to you and what you could do with the little bit amount of money, you could go a long way. So that's the quick philosophy lesson. I could go really deep, but let us get into here what I want to talk about. I'm gonna go now. I just pulled in, so I'm gonna go shoot this video for y'all. I love y'all. Care. All right, so let's get into it. I want to discuss this concept, and again, the strategy we're going to talk about. We're going to cover some of even the earnings plays, and hopefully, we'll see if those assignments worked out and the account stays up here. But I want to talk about the earnings play that we did on Netflix. We also did that other one that we walked away with, and it's going to encompass this kind of risk management approach. But, and I also have plays too. We're going to compare even the Netflixes as well as some of even the Boeings you guys saw we did on Friday. But all of them encompass this topic that we need to discuss. And this is literally what I mean by the only thing you need to become a successful trader, because it is very crucial, if not the most important thing, and that is risk management or capital controls. So the strategy I'm going to give to you right now, and we're going to talk about this, I'm going to rant in between before we really get into it, but it's a very easy one to wrap your head around. This is even used by people in poker, people who even gamble for a living. So I'm sure some of you poker guys could speak to this, but even in general too, why I'm bringing this up and why this is something, whether you want to day trade, whether you want to do options, penny stocks, anything, this is the important thing you need. It does not matter so much about the strategy or what you're doing, your trading news, technicals, fundamentals, anything like that, as much as it has to do with the financial framework that you're applying and how you go about doing something, even opening a business, doing anything. This is where a lot of people mess up on. And this is usually, how you're outlaying your capital. So what I'm going to discuss here, and one thing I like to use, and I've talked about this, is a 1-to-5 risk-reward ratio. So what does this mean? That any trade I'm doing, or I try to focus on this, because again, even now when we start doing certain spreads and all that, it doesn't really apply in that sense because it's a different type of thing we're working on. But theoretically, the risk reward is usually always there. If you're putting up $40 of capital or collateral to get $210 on a spread, you'll make $200, or you have to lose $40 if you get called on it. That's about 1-to-5. The whole idea here with this strategy is that if you're controlling your outlays, so whether you're day trading, when you're going into a position, whether it's options, day trading, anything, how much you use, and then the next important factor, the vehicle to which you're using it in, does it have the ability to meet this criteria, or is it putting you up in a good position? Now, it's not something you always have to do, but the math behind this is that if you go 1 for 5, meaning you make only 1 of 5 trades are correct, but they all have the ability now to make a minimum 500%, if you go 20% success rate at 1 to 5, you will break even, meaning you will not lose money. So you got to expose yourself to all these opportunities, but if you only hit 1 out of 5, you will not lose any money. The best part is now if you hit 2 out of 5, so 2 divided by 5, about 40% now. I think I should have known that. So then if you hit 2 out of 5, you go 40%. You just made 500% on your investment. And then if you magically go 3 for 5, 60%, then you're going to be up over 1,000%. But the whole idea here is, there's a lot of stuff going on with trading, investing, all that. You're going to be prone to make mistakes. You're going to go on streaks and you're going to go on losing streaks as well. But the key should be to preserve your capital. So this is what I'm going to talk about. We're going to highlight, some specific plays that I've done already, and you guys could see both the ones we've hit, and even on that Boeing the other day, this was ringing in my mind all weekend, because this clearly encompasses, both sides of the coin in terms of what was the risk reward. We still did take a risk. It still had the risk reward that we were looking for, but it didn't offer the back end. And now this is where opportunity comes into play, and you guys have to do this. And now this is how you expose yourself to opportunities. And this is why I even gave that little philosophy video. Let the opportunities come to you. Be careful to chase because of what you see other people doing and this and that. Everybody's going to have something that works for them, and that's going to be them. But you have to be very, very strict to understand what you're going to spend money on. Are you most of you wouldn't spend thousands of dollars elsewhere or as frivolously as you would do on the stock market, which is insane. The key is use what grow into what you're doing. But by even having, again, and I'm giving you guys this as a suggestion to see, and actually do options trading extremely risky. You can't lose all the time. What's your financial investment? Please consult a financial advisor. Pretty much, I'm just giving you guys an idea here to go off of. But the key I'm trying to push to you guys to try to do, I'm urging you to do, is control your capital. Have some loose set of plans for it. So you're understanding how much you're risking and then how much you could potentially gain. That way you understand what you could lose, and then you also have to understand what the potential of profit is on the specific investment that you're making. Even now, coming to some of these ranting points here, most people lose their money before they could lose the lesson and learn the lesson. And this pretty much just means a lot of people are coming into the market. They're using too big a position sizes, especially when they go to options or day trading. And again, then there's the vehicle they're putting it into. But then the key is, regardless, let's say that's what I'm saying. I don't care what strategy you want to do. Go ahead, do it. God be with you. Regardless, there's going to be a lot you're going to have to learn and get used to it, just like driving. That's why your first car isn't going to be the nicest car in the world. You're going to make a bump or two. You're going to get into some accident. God forbid you get really hurt, but it's kind of expected. That's why insurance premiums are high for new drivers. So there's going to be a lot you're going to have to get learned and equated to. But if you're pressing the pedal and spending way too much money without any general idea of these capital controls, or literally just going well above something that's just not in line with your budget. How long did it take you to save up your starting capital? And then how long did it take for you to deploy? There's a ratio in that you should probably try to control. Anytime somebody tries to step in something too big for them, it's not going to work. I could offer you a pair of $1,000 red bottoms, whatever you're into, but if they're double your shoe size, you're going to look real goofy in them. And even if you try to pull them off, your feet are probably going to hurt by the end of the night. It'll be stressful. You're like, man, why do I even want these? Where my Skechers at, man? So give yourself time to grow without having to risk everything you need to. And again, like we said, it doesn't matter what strategy you're trading. What are you going to, it doesn't, if you go after trading the news, Donald Trump tweets, you want to go after that. The MACD crosses over the other MACD or whatever, technical support. You want to go off of the Form 4s, the 10Ks, earnings, anything. It's not so much about what you're doing. That plays a part of it. But now, what is the financial framework you're applying? It sucks because it sounds so like old cliche. Don't put all your eggs in one basket. That is a financial framework. It doesn't matter if you approach anything. The best plan with a poor frame, that's not something you're going to want to build on if it's not sturdy and could stand it. So again, you may be good at trading the news. You may be good at reading technicals. You may know everything about fundamentals. But if the problem is you're just acting like a kid in the candy store, and you don't want to put yourself on a budget. You don't want to stick to the budget. You don't want to write down any rules for it. And again, you guys could be looking at YouTube to copy somebody's rules and say, hey, well, what should we do? I want a specific thing here. It's not one size fits all. Just go make up any set of rules and stick to them. And that's where it starts with, because go write down on paper, it should make sense. Use the guidelines to come up with what makes sense for you in terms of how much money is appropriate for you to save, to be putting into it. What percent of your account, if I made 5 trades, go look at your average trades, go look at the trades you've already made and then average them and see, and that could tell you something, and you'll be able to say, well, this doesn't make sense, or it will make sense. So if your last 10 trades, you're putting in crazy amounts of money where it's like a crazy amount of your account in this, it's like, one, if you lost them all, well, what did you end up losing on them, and then go through and why. But now what about the trades you win? What was your profitability percent? Not in terms of how often you were profitable, but how much did you make on them? So now you're risking 5,000, 2,000, whatever, again, or even 30, 40, 50% of your account. But then when you win, your biggest winner, you're only walking away with like 10%, 20%. But then when you lose, you're losing a pretty good amount. You're not giving yourself enough time and you're selling out early. This is financial framework. So hopefully you guys could pick up on this, but have something in that strong basis of understanding what you're risking and then what you're going to get out of it, and try to put a rule. Again, I like this 1 to 5 rule, and that's what I stick with. But even then, you could do the riskiest or the safest trade. The key is how much money you put into it and the sustainability of that. So you can make the safest investment in the world, but if you're putting in way too much money, you might panic in that situation, believe it or not. You won't be able to stand the fluctuations, or you'll liquidate before it has time to come to maturity. Or vice versa, you're going after the big one, but you still put way too big of an amount. You took the risk, but then you put even more. That's it. It's one and done. Versus still, and this is what I want to talk about here with earnings, and you guys saw it with that Netflix trade, you could still take a big trade, but it doesn't mean it's going to have to be more risky. So, we did this Netflix trade, and this was a pretty big trade considerably, especially the account was only at like $800 or $700 at the time because we were losing on it. Again, we came up, we came down, when we brought it up, we were at like $1,200, $1,000, then it came down here to like $800, $700. But then we made that play here. But the key was I already had a play where I was risking essentially the same amount of money. That is why I switched it over here. And even then, I could have risked more if I wanted to, and we could have made this a $500 play, 50% of the account. But with the risk to reward ratio, $200, that was the initial risk. That was all we needed to be able to even get $1,000 potential profit. That $200 would have been enough. That 25% if the account's at 800, 25% right there, that was enough to more than double the whole entire account. So it's understanding, even if you're going to do something more risky, you still have to keep it in line with how you're controlling your capital. And if you're able to do that, you'll take it a long way. And now this leads to the next point, and then we're going to get into the plays. I'm going to show you these examples, and if you guys have been on live, you've seen these. But understand the difference between the risks that you're taking. Again, this is why I cut out of the Disney and why I went into this play. The dollar amount is one thing, but what about what is implied? This is where I'm saying IV becomes important, because every single trade now, even then, the risk on Disney, believe it or not, was more. I had $300 of collateral required for that trade. This trade required $200. But then again, what was the reward? This trade, $1,000. The other trade was only $150 net profit. So again, each one of those now has two implications. One, the risk to rewards both imply the probability and likelihood of each play. Remember, the more money you receive, usually the less probable that chances of you winning. So on this one, make $1,000, put up $200, that's probably not going to happen. Versus put up $300 to make $150, the odds are actually in our favor. But now, even if I'm getting less to take that risk, we're also rolling over. That could be implied there. But then also now, too, what was going on with Netflix, there was another thing being implied, and that's earnings. So there's more going on. So even though they could have been the same risk, the dollar risk and everything, and had different probabilities, one had more going for it. One was earnings. So that $20 in an earnings play is going to be a lot different than $20 doing nothing, or in a stock that there's no other catalyst. So you're telling me earnings has one of 4 times a year the stock can make big moves. There's going to be surprises with the option chain. Market makers could be grossly wrong. Are you going to take that same risk at the end of the week that you're already going to take, even if it's only $10, not even $200, and put that into something with nothing going on? or are you going to put it towards something where there's actually an event? Now, if this gave us a really, really unlikely play, then this one wouldn't have been good. So sometimes, even though if the event has something going on, so there's an earnings, and I think Amazon could be a good example. The earnings is coming up, but now based on the premiums, even if you wanted to put, a play in there, it would be so far out of the money, or the probability it wouldn't make sense. It makes sense why the other play would be good. But in this case, when we did the play, Netflix had a very, very wide range in terms of what it paid us, and allowed us to really, I was only like $3 shy of what the market makers were pricing in to get this same risk. That was a good one. So keep this concept in mind now, because now this even leads into some of the stuff I wanted to show you here. You saw that Netflix play, and again, if you're not familiar with the Iron Condors options, check the other videos, we have that. But in this case, $200, and this is what I'm saying, it doesn't matter. Let's boil it down to the straight numbers of it and what happens. And the only way you could do this, if you understand the risk and you understand how the value will go up to understand what you're going to really receive. The max risk on this is 200. The max we could receive is 1,000. So that's if you did the Iron Condor. So now what if we just wanted to buy a put coming in earnings? So we thought it was going to go down, and look at what Netflix did. It did indeed go down from its earnings. It shot up and then came down. You see how that led us to profitability. And even the ironic part on this play, take a look. This is literally the day after. This is the day before earnings. Remember, we did it right at close. We got 210 for it. It went to 213. And then what happened the next day? Literally right in the morning. No exaggeration, right in the morning, we were already up on it. $20 on 5 contracts. Even though the stock opened up higher than our range, we instantly won on it, and then it just started coming down and plummeting. And then, because again, if we sold it at 210, we collected the credit. When it goes down, we win. This play made us a winner, right? Even if it went up and then came down, and that kind of in our what we had in mind. But now let's take a look here. What if you just wanted to put, and you wanted to put up and buy $200? The first thing you need to ask yourself is, okay, well, what am I risking? Same $200. Now, what would it take? There's still the earnings, but if you bought this play, so take a look, coming into the day before earnings, right at close, these are going for $195. How about the $225? We'll say the $240. So you bought a Netflix $240 put. Stock is trading at $287. You're buying a $240 put for next week. So you're saying, I'll play the earnings and get some time just in case maybe it goes up and ends up coming down. Awesome. That could be your logic. But now what is the tool you're using? And then now factor in this risk reward. But what we're asking here is, what will it take for you to be profitable? You buy a $240 put, meaning somebody agrees to buy the stock from you at $240 a share. So you make money if the stock goes below $240, because then you could sell it to them at $240 while buying it cheaper on the open market. And then you also you realistically need it cheaper than $238 because you spent $200 for that right. What would that really take? By next week, you would need this contract in the money by at $235 or $233. Because then if you could buy the stock at expiration for $233, you sell it to this guy at $240, you make $7 per share. That's $700. But then you spent $200 for the contract, you're walking away with $500. So that's even just under 300%. And you would need, so keep that in mind, but then you would need the stock to go down to $233, which is even well below where it was at there. If we really wanted to do the math, 274.04 minus, we need that what, to 233? $41, divide that by 271. You need a 15% move. Crazy part, I did that calculation from the bottom after it's already moved more than that in the last few days, over 6% every day there. So you risked $200 to potentially make only 300% if a very, very low probability event occurred on the earnings. So I'm not saying this to say, wow, our play is the best, but the key is now, what are your options? You have to either decide that or figure out another play. Maybe if you did a debit spread, this is why we have the videos on debit spreads. Maybe you could have pulled this play off instead. Maybe you got in the money, or look at these contracts that ended up in the money after that event. What would have been the risk to reward? This is $13.27 you could have bought it for. So you could have bought the 280. That would have cost you $13.50. Then you could have sold this for $12.50. So this would have cost you $100. So this would have cost you $100 to get in the money, but you would have only made $250, and then you spent $100. You're really only walking away with $100. But you're winning, and then now think of your risk. It's a 1-to-1 on there. So going through all this, you have to decide, well, I could actually make a play that makes sense. And if you do want to realistically take advantage of an opportunity, is there a reliable risk to reward ratio there? But also understand, again, what it's going to take to make those plays. So that's one of those examples. And now putting this in context, let's play the next one. You know, this was us playing Boeing in the news event that we saw yesterday. This one was a trip. Oh man, we can't see the weekly, but what we did, if you guys remember, we caught the news almost instantly. I made a video on it, and what I did, I made this exact mistake. I took a play, and the risk reward, what I did, the stock was dropping there on Friday. You see here, we caught it literally within the first minute. It was insane, and we saw this all develop. But what I did was I did a daily credit spread, and I sold a 355 and I bought a 357. I sold it for $230 credit, and my max risk was $20. So my max risk was $20. If I was right, I would make about 1,000%. I'd make $230. So it's a solid risk to reward. But but doing this trade, why did I do it? And this is what usually influences all these trades, is it's understanding how you were going to profit, you know. So in this coming down, why did I go with the credit spread? Well, I said, okay, Boeing, it's bad news for Boeing. We don't know how far the rumors will take it, considering, you know, Boeing has just been up and down and literally been plagued by these news events over and over. And sometimes it'll even bounce on the worst news. We don't know. But I thought it was big velocity. It had enough weight where I was like, okay, it can make sense. I took that risk where it was only a $20 max risk. By doing this spread, I cap how much money I could make, but it offered me another degree of profitability. Whereas if the stock just went down and bounced and went up, I'm taking advantage of the premium. And if that fell out, it would make it easier for me to win rather than buying a put and trying to pinpoint exactly where it's going to drop to. But in that case, I only ended up, I walked away with $100. I was up like $120. There was 500%. I took it, and then it kept coming down. But literally at the same time, even if I just went to the next week, 355, these were going for $300, which is actually insane. But they were 10 times less on the weekly. It was the same $20 to buy the weekly. And at the end of the day, that probably would have made more sense to do now, because even though it was the same $20 or $30 risk, it wasn't the same $20, because this one offered me way more upside. Let's say the news did have legs, and it did, I would have been able to make way more, and now I could have consistently repeated that play. Now, going with selling a credit spread on the news like that and playing $20, but having the odds in my favor of being a credit spread, that was still sustainable too, because either way, both scenarios, I would have lost the $20. But now one of them offered more upside to give me more sustainability if they did in fact hit. So this is kind of letting me get an idea of which trade was better. Now, every situation is going to be different, and that's where you guys are going to have to learn. And even what I'll finalize this with, and looking at others, looking at this and that, the key is be careful. Don't get too greedy, because if this is going to now lure me into playing these dailies and this and that, I can't lose sight of the risk management and the max risk. But it doesn't mean that this wasn't the worst play, but it does mean being able to balance and find it when the opportunities are the best here. So you can focus now on the reward as long as you've managed the initial risk. So again, both risks were exactly the same, but the rewards offered were different. Then you could do that, and then you have to actually analyze, does it make legitimate sense to go with one? In this case, the buying the put made literally the most sense, because what are the two outcomes? If the only reason I gave up max gain to be right if the stock landed at 355 at close, because anything above 355, let's say the stock was at 356, I would have still lost. I maybe would have made a little bit, but if I bought this one, you bought the put, you would have lost as well too. But now anything below 355, I would have not made as much money, but this I would have. So it's understanding these were very, very similar, but there was just a specific instance that I traded in max risk or max gain to get the privilege of being able to make money in a certain instance, where this one offered something different, but it was actually logically and rationally the better one. And that's where hopefully you guys are able to make that decision with all your trades. Is I want you guys to use risk reward, understand this capital management, and please feel free to ask questions, come on live, everything, and go through your trades and journal them. So you like, hey, did this make sense for me to do? Something I could repeat, you know, why is it that you were going little by little and then you took a big one out of nowhere? And then why did you go big on that trade? And this is why coming into earnings, be very smart with the companies you want to play and go after start with the risk reward, figure out what you're going to lose. Well, again, budget everything, and now even set aside how much are you going to play on earnings? What would make sense for you to go after these opportunities, and then go find the plays that are going to offer this, and don't play random obscure stuff where you're going to take the same risk and then get a less reward. That's the key. But again, you can't think about reward until you have the risk managed, or you understand what it is and why. If you're going to get more reward, and it would make sense that you're getting more reward, essentially the risk and probability has to be the same. And in this case, selling the 355 or buying the 355 was essentially the same. So that is pretty much it, though. I'll leave you guys with that. Let me know what you think. Give me some of your feedback, and I'll see you tomorrow for the watch list, baby. Let's go!